Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.13 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover a full suite of drawdown control concepts. We will start by defining what a drawdown control system actually is and why it matters for every trader. Then we will discuss why you must keep an eye on drawdown as early as possible. We will walk through a simple real-world example using an euro to US dollar trade, so you can see the numbers on a chart. Next, we will point out the common beginner mistake of ignoring drawdown limits and explain how over-leveraging makes the problem explode. After that, I will give you a step-by-step guide to setting a maximum drawdown threshold, show you how to implement stop-loss orders and equity alerts, and finally demonstrate how to fold drawdown control into your overall risk management plan. To wrap things up, I will hand you a quick checklist you can copy into your trading journal right now. By the end of this video, you will understand what drawdown is, how to protect your account before losses become catastrophic, and you will have a ready-to-use system you can activate today. Let's get into it. All right, let's break down what we mean by drawdown control system. First, the word drawdown simply describes the amount of money your trading account loses from its highest point, also called the peak, to a lower point before it recovers. Imagine you're climbing a hill with a backpack full of gold coins. The highest spot you reach is your peak. If a sudden gust pushes you down the hill, the distance you fall represents your drawdown. A drawdown control system is like a safety harness that automatically tightens when you start to slip, preventing you from falling too far. In trading terms, this system includes rules, alerts, and automated actions that stop or reduce losses once they reach a predetermined level. Why is it important? Because every trader, no matter how good their strategy, will experience losing trades. Without a control system, a single bad streak can wipe out weeks or months of profits, or even the entire account. Think of it as a thermostat for your account. You set the temperature you are comfortable with, and the thermostat turns the heat off when it gets too hot. Similarly, you set a maximum drawdown percentage, say 5% of your total equity, and the system triggers a stop loss, reduces position size, or sends you an alert the moment you hit that limit. This protects your capital, keeps you in the game longer, and gives you the mental space to analyze what went wrong instead of panicking. In short, a drawdown control system is the guardrail that keeps your trading journey on the road rather than off a cliff. Now that we know what a drawdown control system looks like, let's talk about timing. Monitoring drawdown early is like checking the fuel gauge before you run out of gas. If you wait until the tank is almost empty, you risk being stranded on the side of the road. In trading, the moment your account equity starts to slip from its peak, you should have a clear view of how far it has fallen. Imagine you opened a euro to US dollar position at 1.1000 with a $10,000 account. After a few hours, the market moves against you and your equity drops to $9,500. That's a 5% drawdown. If you have an early alert set at that level, you receive a notification and can either tighten your stop loss or close part of the trade before the loss deepens. If you ignore that early signal, the market might keep moving and your equity could fall to $8,000, a 20% drawdown, which may trigger a margin call or force you to close at a much worse price. Early monitoring also helps you spot patterns. Perhaps a particular currency pair tends to pull back after a certain news event, and you can adjust future trades accordingly. By catching the dip early, you preserve more of your capital, reduce emotional stress, and keep your trading plan intact. Waiting too long not only magnifies the loss, but also erodes confidence, making it harder to stick to disciplined strategies. So the rule of thumb is, set your alert as soon as you define your maximum acceptable drawdown, and treat every early warning as a cue to act, not as a suggestion you can ignore. Welcome back, looters. Let's walk through a simple, real-world example of a drawdown control system, so you can see exactly how it works in practice. Imagine you have a brand new Forex account with $10,000. Think of it as a small savings jar you're using to learn trading. The first rule we set is a maximum drawdown of 5%. In plain English, that means we are willing to let the account lose at most 5% of its value before we stop trading or cut our positions. 5% of $10,000 equals $500, so our drawdown limit sits at $9,500. Now picture you open a trade on the euro to US dollar pair at 1.1000, buying one standard lot worth $100,000. The market moves against you and the price drops to 1.0900, causing a loss of about $900 on that single trade. Your account equity falls from the peak of $10,000 down to $9,100, which is a 9% drawdown, well beyond our 5% rule. Because we have a drawdown control system, an automated alert would pop up the moment equity hits $9,500, and a pre-programmed stop loss would close the position to prevent further loss. At that point, you either pause trading for the day, reduce your position size, or reassess your strategy. This simple rule acts like a safety valve on a pressure cooker. It releases steam before the pot explodes. By enforcing a $500 limit, you protect the bulk of your capital, keep your emotions in check, and give yourself a chance to learn from the mistake without wiping out the account. Remember, the goal isn't to avoid every loss. It's to keep losses small enough that they never threaten the health of your trading jar. Now let's put a picture to the idea of drawdown by visualizing it on a real euro to US dollar trade. Imagine you start the day with a $10,000 account and you decide to buy euros when the pair is at 1.1000. In our chart, the green candle marks that entry point. Think of it as the moment you step onto a moving walkway heading upward. The price climbs a little, and your account equity follows, reaching a new high of $10,200. That peak is the highest point your balance has ever been during this session, and we label it peak equity $10,200 in bright white, so it stands out. Suddenly, the market reverses, and a euro to US dollar slides down to 1.0900. The red bearish candle shows this drop, and your trade loses about $900. As the loss accumulates, the equity curve, shown as a line beneath the price chart, slides down to $9,300. This lowest point is called the trough, and the difference between the peak $10,200 and the trough $9,300 is your drawdown, which in this case is $900, or roughly 8.5% of the original account. On the chart, we draw a horizontal red line at $9,500, representing a 5% drawdown limit for a $10,000 account. Because the equity line crosses below that line, an alert would trigger, and any preset stop loss would close the position automatically. By looking at the chart, you can instantly see where the account was healthy, where it started to bleed, and exactly how far it fell. The visual cue of the red line acts like a traffic sign that says slow down or stop. It tells you when you've entered dangerous territory. This visual method helps you react quickly, prevents emotions from taking over, and keeps your trading account from taking a hit larger than you're comfortable with. Finally, let's talk about a mistake that many beginners make: ignoring drawdown limits altogether. Picture two friends, Alex and Sam, both starting with the same $10,000 trading account. Alex follows the 5% rule we discussed earlier, setting an alert at $9,500 and a stop loss that automatically closes any trade that pushes equity below that level. Sam, on the other hand, decides to ignore the rule, thinking I can handle a bigger loss, and never sets any alerts. In the left panel of our diagram, Alex's equity curve climbs to $10,200, then drops to $9,800 before the stop loss kicks in, keeping the loss under the 5% threshold. The red horizontal line at $9,500 never gets crossed, so Alex stays in the game and can learn from the trade without wiping out the account. In the right panel, Sam's equity line plunges from $10,000 all the way down to $7,500, a 25% drawdown, because there was no safety net. The red warning sign, ignore drawdown, highlights how quickly the account erodes when you let losses run unchecked. This mistake is like driving a car without a speed limit sign. You may feel in control, but a sudden obstacle can cause a crash. Ignoring drawdown limits also amplifies the psychological pressure. As the balance shrinks, fear and frustration grow, leading to impulsive decisions that can make the loss even worse. By the time Sam finally notices the problem, the account has lost $2,500, which could have been avoided with a simple rule. The lesson here is crystal clear. Treat drawdown limits as non-negotiable traffic rules on the road to trading success. Set them, respect them, and let the system protect you before emotions take over. Even if you feel confident, the market can turn on a dime, and a disciplined drawdown control system is your most reliable safety harness. Welcome back, looters. Let's dive into why over-leveraging can turn a modest loss into a painful drawdown. First, leverage is like borrowing money to buy a bigger slice of a pizza. If you have $1,000 in your trading account and you use 1-10 leverage, you can control $10,000 worth of euro to US dollar. That sounds powerful, but it also means every price move is multiplied 10 times. Now, imagine you decide to crank the lever up to 1:100, letting you control $100,000 with the same $1,000. In our example, you open a long position on euro to US dollar at 1.1000. A single 50 pip drop, which is only 0.0045 in price, would normally cost you $45 on a $10,000 position. With 1-10 leverage, that $45 is a small bite. But with 1:100 leverage, the same 50 pip move costs $450, 10 times larger. If your account only has $1,000, that $450 loss is a 45% drawdown, meaning your account value has shrunk by almost half. Drawdown measures how much your equity falls from a peak to a trough, and large drawdowns are dangerous because they reduce the capital you have left to recover. Over-leveraging amplifies both gains and losses, but losses hit first and can wipe out your ability to stay in a market. Think of it like driving a sports car with the brakes disabled. You might accelerate quickly, but any slip can cause a crash. The key takeaway: keep leverage modest, so when the market moves against you, the resulting drawdown stays manageable and you preserve enough equity to stay in the game. Now that we understand why drawdown matters, let's walk through a step-by-step method to set a maximum drawdown threshold that protects your account. Step 1. Find out your current account equity, which is simply the total cash you have plus any unrealized profit or loss. Suppose you have $5,000 in your demo account. Step 2. Decide what percentage of that equity you are willing to lose before you stop trading. For beginners, a common rule is to keep drawdown under 2% of your account. That means you're comfortable seeing your equity dip by no more than $100. Step 3. Calculate the dollar amount of that limit. Multiply $5,000 by 0.02, and you get $100. This $100 becomes your maximum drawdown dollar limit. Step 4. Translate that limit into a concrete equity level. Subtract $100 from your starting equity, so $5,000 minus $100 equals $4,900. When your account balance falls to $4,900, you have hit your drawdown ceiling. Step 5. Create an alert in your trading platform. Most brokers let you set an equity alert that notifies you when your balance reaches a certain number. Enter $4,900 as the trigger point and choose a loud sound or email notification. Step 6. Decide what action you will take when the alert fires. A disciplined response is to stop opening new positions and review existing trades, possibly closing losing ones to prevent further loss. By following these 6 simple steps, you turn an abstract risk concept into a concrete rule that your trading software can enforce. The practical takeaway is clear. Calculate 2% of your account, set an equity alert at that level, and treat the alert as a stop sign that forces you to pause and protect your capital. Finally, let's bring everything together by implementing stop-loss orders and equity alerts, the 2 tools that act like safety nets for your drawdown control system. A stop-loss order is an instruction you give your broker to automatically close a trade when the price reaches a level that would cause an unacceptable loss. Think of it as a built-in exit door that you set before you even enter the room. For example, you buy euro to US dollar at 1.1050, expecting the price to rise. You decide that a 100 pip drop would be too much, so you place a stop loss at 1.0950. If the market moves down and hits 1.0950, the broker instantly sells your position, limiting the loss to those 100 pips. This protects your equity from eroding further. The second tool is an equity alert, which monitors the total value of your account, not just individual trades. Using the numbers from the previous scene, you set an alert for $4,900. When your balance hits that threshold, you receive a pop-up, sound, or email. The alert is a reminder that your overall drawdown limit has been reached, prompting you to stop adding new positions and perhaps tighten existing stop losses. To set them up, go to your broker's platform, locate the order or trade window, and enter the stop-loss price in the designated field before confirming the trade. Then navigate to the Alerts section, choose Equity Level, input $4,900, and select your preferred notification method. Once both are active, you have a dual-layer protection. Each trade can't lose more than its individual stop-loss, and the whole account can't fall below the drawdown ceiling without you being warned. The practical rule to remember: always place a stop-loss on every trade and pair it with an equity alert at your maximum drawdown level. This combination keeps individual losses small and safeguards your overall capital, giving you the confidence to trade without fearing a sudden wipeout. All right, looters, let's bring drawdown control into the bigger picture of risk management. Think of your trading account like a personal budget. You wouldn't spend every dollar you earn without setting limits, right? The same principle applies to a trading account. First, you decide how much of your total capital you are willing to lose before you stop trading. That's your maximum drawdown. For a beginner, a common rule is 10% of the account. If you start with $10,000, your drawdown ceiling is $1,000. Now, risk per trade is the next piece of the puzzle. Most mentors suggest risking no more than 1% of the account on any single trade, which would be $100 in our example. As long as your equity curve stays above the $9,000 line, you keep using that 1% rule. But imagine a series of losing trades pushes your equity down to $9,200. You've already lost $800, which is 80% of your allowed drawdown. At this point, you tighten the screws. You might have your risk per trade to 0.5% or $50 to give the remaining $200 of drawdown buffer a better chance of lasting longer. Integrating drawdown control means you constantly compare two numbers: the current drawdown amount and your preset limit. If the drawdown approaches the limit, you automatically adjust other risk parameters, reduce position size, widen stop-loss distances, or even pause trading for a day. This creates a feedback loop where each component protects the other. By treating drawdown as a budget line, you keep your overall risk in check, avoid blowing up the account, and stay in the game long enough to let your strategy prove itself. In short, drawdown control isn't a separate tool. It's the glue that holds together position sizing, stop-loss placement, and daily trade limits into one cohesive risk management system. Now that we understand why drawdown control matters, let's give you a quick, actionable checklist you can copy into a notebook or a spreadsheet. This checklist turns abstract concepts into daily habits, so you never forget to protect your capital. 1. Define your maximum drawdown. Write down the exact dollar amount or percentage you will not exceed. For a $5,000 account, many beginners start with a 10% cap, which equals $500. 2. Set an equity alert. Most trading platforms let you create an alert that fires when your equity falls to a certain level. Set it at 90% of your original balance, so you get a warning before you hit the limit. 3. Program a stop loss for every trade. Before you click enter, decide the price where you will automatically exit a losing position. Use the same risk per trade you calculated earlier. For example, $50 on a $5,000 account. 4. Review the equity curve after each session. Open your account's equity chart. Look for any red shaded area that indicates drawdown and note how close you are to the limit. 5. Adjust risk when drawdown exceeds 50% of your limit. If you've already lost $250 of a $500 limit, have your risk per trade to $25. This gives the remaining buffer a better chance to recover. 6. Pause trading when the limit is hit. The moment your equity drops to the exact drawdown ceiling, stop opening new positions. close existing trades if needed, and take a break to reassess. 7. Weekly journal entry. At the end of each week, write a short note confirming you followed each step, what the drawdown was, and any adjustments you made. This reinforces discipline and creates a record you can review later. By ticking off each item daily, you build a safety net that catches losses before they become catastrophic. The checklist is simple, but the habit of reviewing it consistently is what separates successful traders from those who get burned out. We've just wrapped up the final piece of today's lesson on drawdown control systems, and you now have a solid framework for protecting your account while you chase those profitable moves. Remember, the key is to treat drawdown like a budget line. Integrate it with position, sizing, and stop-loss rules, and then follow a simple daily checklist to keep everything in check. If you found this walkthrough helpful, go ahead and smash that like button. It tells the algorithm that you value this content and helps more traders discover the video. Don't forget to subscribe to Tick to Loot and ring the notification bell so you never miss a future lesson. We drop new insights every week. Now I'd love to hear from you. What was the most useful thing you learned today? Drop your answer in the comments below, and feel free to share any questions you still have about drawdown management. I'll reply personally. Your feedback helps shape the next videos and builds our community of disciplined traders. That is everything for Lesson 11.13, Drawdown Control Systems. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure. All right, looters. Before we wrap up today's deep dive into drawdown control systems, it's important to lay out a quick disclaimer and give you a sneak peek at what's coming next. First, everything we discuss on Tick to Loot is educational content meant to help you understand the concepts behind Forex and algorithmic trading. It is not financial advice, and it does not constitute a recommendation to buy, sell, or hold any currency pair, such as euro to US dollar, pound sterling to Japanese yen, or any other instrument. Trading involves risk, and you should only risk money you can afford to lose. The examples we use, like a hypothetical euro to US dollar trade that drops from 1.1200 to 1.1050, are purely illustrative and not a guarantee of future performance. Always do your own research, consider your personal financial situation, and, if needed, consult a qualified professional before making any trading decisions. Now, looking ahead, our next lesson in Unit 11 will focus on position sizing algorithms. We'll explore how to let a computer calculate the exact lot size for each trade based on your account balance, risk tolerance, and the specific volatility of the pair you're trading. You'll see step-by-step code snippets that automatically adjust your position so that a 2% drawdown never exceeds your predefined limit. We'll also cover how to backtest those algorithms on historical data, so you can see how they would have performed during real market events like the 2022 Eurozone inflation surprise. By the end of that session, you'll have a ready-to-use script that helps keep your risk consistent, no matter which market you trade. Stay tuned. Hit the like button if this disclaimer helped clarify things, and remember to subscribe so you won't miss the next lesson. Keep protecting your capital, and see you soon, looters.